Hey, it's Jeff Green with Green Financial Group. Thanks for tuning the video blog today. Today, we're going to talk about tariffs and the impact on the U.S. economy. Stick around, I'll be right back. So the U.S. economy has become very imbalanced, and that's been driven by excessive consumption and insufficient domestic production. Since 2007, inflation-adjusted consumption is up 62%. So consumption is up 62%, and manufacturing output is only up 12%. So where's the 50% difference coming from? Imports, right? So hence the tariff. So government spending has also grown from less than 10% of GDP to nearly now 25% of GDP. Taxes, regulations, and redistribution have discouraged investments and savings. And that kind of growth has resulted in a very fragile economy. So you look at supply side economics, that's Reagan style, for instance, reducing taxes, cutting regulation, and shrinking government are typically seen as paths to very sustainable growth. So now here come the tariffs, right? So the tariffs are not ideal. I personally don't really like them. I'm more of a free trade guy. I think we should be able to buy and sell wherever we want. But the tariffs, while not ideal, are being used as a tool of last resort to force global rebalancing and reduce dependency on imports. Tariffs are a tax, not inflationary, but they are a tax. And short-term negative, but they may drive long-term structural improvements in U.S. competitiveness. So I'll give you an example. So before, I think the last number I heard was 104% tariffs on China. And by the way, I want to make this note. It is April 10th today. And it's going to be 2 weeks by the time production and compliance and everything gets through this. And so the world may have changed tremendously by the time you actually see this video. So I just want to put that out there. So currently, before anyway, the 104% tariffs on China, China had a 49% tariff on U.S. autos. The EU had a 10% tariff on U.S. autos. Meanwhile, we only charged a 2.5% tariff on theirs. So not quite equal. So the long-term goal here, encourage domestic production, reduce reliance on geopolitical adversaries, and foster innovation right at home. So if you look at the market, I know we've seen a tailspin in the markets. They were already overvalued. I think anything could have been the catalyst that caused this. I think you can even make a case that DeepSeek was one of the catalysts because the Magnificent Seven, all of the big tech stocks, they went down significantly. I don't know the exact number off the top of my head, but really the decline in those started going down in those stocks at that time, long before tariffs were announced. But everyone's blaming it on tariffs, so let's say tariffs are the catalyst, but it could have been anything. Now, we've also been hearing the word recession thrown out a lot. We believe a mild recession is likely, not guaranteed, but certainly not a crisis. Nothing like a 2008 recession, nothing like the Great Depression. It's nothing like that. I think it would be a fairly mild recession lasting a few months at most, 6 months max. I don't even think it's going to last that long, but that's our opinion. Because, for example, even we had 0% profit growth, corporate earnings remain well above pre-COVID levels. So part of these tariffs are to bring, again, the manufacturing back home, right? So when you think of manufacturing, the U.S. is not going to go back to socks and sneakers. That's not the manufacturing we're talking about. It's more modern, automated, high-tech manufacturing. This is what should expand. So you expect a resurgence in robotic and software-driven factories, not low-skill manufacturing jobs. And these jobs will be higher-paying jobs, supporting a strong middle class and local economy. So focus is on the long-term economic health, even if the short-term pain, that's market volatility and tariffs, even if that's required. So this is similar also, if you remember, old enough anyway to remember Reaganomics, okay? Reagan's policies back in the 80s, they were painful, but ultimately effective. In our clients' portfolios, we have already been moving weeks and probably a month or so ago, we started moving away from more speculative companies with more speculative earnings and into what we perceived as companies with more reliable earnings. So this is a way to insulate or help insulate your portfolio. So make sure you talk to your financial advisor about concerns about the market, whatever concerns about the economy that you might have. But if you're concerned about your portfolio and would like a second opinion, we'd welcome your call. Again, the best thing you can do we've made some minor tweaks with our clients' portfolios, but beyond that, the best thing to do, stay the course. Thanks for tuning in. Any questions, concerns, or comments, feel free to give us a call.